In this video, I'm going to show you the easiest way to value stocks quickly using a completely free tool. Alright, so here's the discounted cash flows calculator that we're going to be using, and I'll put the link in the description for the website below. So we're going to use this calculator to value Facebook stock. Now let's start by filling in the variables. The calculator calls for earnings per share last 12 months, but we're going to use free cash flow per share instead because it's a better representative of the cash that can be distributed to owners. And we can find what that is on Morningstar no problem by navigating to the Key Ratios tab and clicking here on Full Key Ratio Data. This is the trailing 12 months column, and for some reason free cash flow per share isn't showing here, so we'll just calculate it ourselves by taking the free cash flow amount right here and dividing it by the number of shares outstanding right here, which calculates to about $11.13 of free cash flow per share. So this is the amount of free cash flow per share that Facebook has earned over the past 12 months. So we'll plug that into our calculator right here. The next field to fill in is the expected annual growth rate of the future earnings, and in our case, the future free cash flow. To find that, we can go back to Morningstar, scroll down, and navigate to the growth tab right here, and we'll look at this section right here. EPS stands for earnings per share. And although they don't have the free cash flow growth rates showing here, it's pretty safe to assume that the growth rates for earnings per share and free cash flow per share are going to be pretty similar. And we're going to be conservative with our estimates for the future anyways, so instead of predicting that future cash flows will continue to grow by 50% plus, we're just going to enter 20% in this field for right now. Next, we'll enter what the growth rate will be beyond year 10 and into infinity. And for this variable, we're going to enter 4% just to be conservative again. And the reason we're using 4% because that's about the rate of inflation. Now, the final field to enter here on this calculator is what is the return available on an appropriate benchmark investment like the S&P 500. And now for this, we're going to temporarily enter 8%. And we're going to use 8% because although the S&P 500 has returned about 10% annually historically, I think moving forward, that will be closer to about 8% annually. When we hit calculate, it tells us that the value of Facebook stock is pretty high. And when we look at what Facebook shares are trading for right now, it would appear as though Facebook is pretty undervalued. But before we come to that conclusion, let's look at our calculator again, and we'll go back to that discount rate field. We've entered 8%, and so let's change that for a minute. Entering a 10% discount rate lowers our value per share. Entering a 12% discount rate again lowers our value per share. And if we change it to a 14% discount rate, it puts our value a lot more in line with what Facebook stock is currently trading at. Now, another way of looking at this is that this is telling us that if our growth estimates for Facebook turn out to be accurate, then buying Facebook stock today at its current price would give you about a 14% annual return on your investment. So what's next? Well, I chose Facebook for this example because it's one of the more favorably priced stocks that you can buy right now compared to what else is out there. But it's hard to make an investing decision when you don't have anything to compare it to. So what I've done here on the right side of the screen is I've done the exact same exercise that we just did, but for Coca-Cola stock, which is currently trading at a price of $56.16 per share. Now I've entered a 5% growth rate for the next 10 years and then a 4% growth rate into perpetuity. And the conclusion is that using a 9% discount rate, we get a value that is about the same as what it's currently being priced at by the market. In other words, buying Coca-Cola stock at this price will be an investment that will give you about roughly a 9% annual return on your investment. So which investment would you rather make right now? Facebook or Coca-Cola? For me, it would be Facebook. They're both trading at a similar price relative to the free cash flow that they're generating, but Facebook has much more growth in it than Coca-Cola does moving forward. Investing in Facebook stock versus Coca-Cola stock right now is a fairly easy decision the way I see it. But if we bought Coca-Cola stock, we would still be getting a return on our investment, but there would also be an opportunity cost to buying Coca-Cola stock over buying Facebook stock right now. And that's why valuing only one stock is actually kind of pointless, because how good an investment is depends on how good the investment alternatives that are currently available are. If we did this exercise we just did with 100 different stocks, we'd find that there are some that are clearly much better investments than others at their current prices. For some though, especially some at the top of that list, it'll be much harder to decide which ones should be ranked above the others in terms of how attractive of an investment it would be. And for those ones, you're going to need to make a value judgment for yourself, considering the estimates you're using and the likelihood and probabilities of that future playing out the way you've estimated. And of course, you can always buy a handful of the ones that you think are the best opportunities to give you a little bit of extra protection against mistakes, especially the newer you are to investing and stock picking. Please like this video to help me out. I do respond to every single comment, so if you have any questions, put them in the comments. And this isn't financial advice, and I'll see you over in the next video. Thanks for watching to the end.